The time has come for you to start looking into buying some real estate, and I'm excited to tell you that it's not as hard as you think when you understand how the process works and you can get rid of that confusion. Yo, my name is Joseph Barr. I am Mr. Make Moves. Welcome to the Make Moves with Us network, where I'm going to show you the buying process really quick. So, if you're looking at this video, you're thinking about getting ready to purchase a home, which is incredible. So, I'm going to break it down for you so you can see what you can look forward to as far as getting the financial process of buying a home ready. There's some other parts that I would highly encourage that is not listed on the board that I will go over at the very end of this video. So make sure you stay tuned to get those incredible other things you can look for when you start building a home. Okay, y'all, welcome to my whiteboard. It's really quick. I kind of laid it out for you, but I just want to touch on a few things for you so that way you're more aware and you won't have to be as scared or confused or worried when you're starting this buying a home process for your personal residence. So the first thing everybody is always scared of is just the down payment process. So the down payment can go anywhere from 3.5 all the way up to 20% or how much ever you want to put down on a home. All right, most government loans, the FHA or conventional, they require at least 3.5 or 5%, respectively. But there's something called down payment assistance. Before you even start looking at your home, I always encourage people just look and see what the down payment assistance can offer to you so you're not having so much money out of your pocket. So look into a down payment assistance program. I'm going to put a link down below of a good down payment assistance program here in Texas that you can look into to see if you qualify. It's never hurt to look. The next thing is a USDA loan. A USDA loan actually gives you 0% down payment, and they are just located in different kind of areas and rural areas, if I should say. So things that don't have a lot, that's not into the city limits, like the real suburbs, country life. So you're able to get a house with no money down on a USDA loan. So definitely check that out too before you start home shopping and see if that's something that can work for you and your family. These are usually individuals that are not afraid to commute or that works from home primarily. Okay. Another is a VA loan. If you served in the military or if you know somebody that will be living in a house that's serving the military, look into a VA loan. Y'all, I'm trying to give y'all some ways to save some money, to put some money into your pocket. So you got the down payment assistance, USDA loan, or the VA loan. And I always say, hey, think about anywhere from 3.5 to 20% when you're trying to get the home. I'll show you where the 20% really comes in just a minute, but that is not everybody's case. There's other ways you can get the home with a little bit of the down payments. Okay. Next thing that a lot of people miss is closing costs. So, what are closing costs? Closing costs is title fees. These title fees can be the appraisal fee. So, for somebody to go out to the home that you're getting ready to purchase and tell the full value of the home, so that way the lender is willing to lend the money based upon the value of the home, you have to pay money for that. Okay. Next is lender fees. For the lender to put all the paperwork together, how to do all the stuff, how to run all the calculations, how to secure your rate lock, everything like that. That is lender fees. Title search, they're checking to make sure on this home that there is no kind of liens. And what are liens? Liens are things that people are owing other people and they haven't gotten paid yet. So they put it on the house because they want to make sure they get paid. So that way later on, if you ever try to sell a house, you don't have to try to pay them too. So they do a title search. So you get title insurance in that process too. You have to pay for that. Recording fees for them to actually go down to the county and record your house value, how everybody went through your deed and everything, putting all your paperwork together. Yes, you got to pay for that. And then it's just more and more fees. Okay. So we call those closing costs. Those are anywhere from like 3% of the home value to 6% of the home value. Okay. So let's take, for instance, you're buying a house that is 300,000. That means these closing costs can be anywhere from 3,000 to $6,000. Ooh, not 600,000. That would be crazy. $6,000. Okay? So keep this in mind. So on top of the down payment, you also need closing costs. And sometimes that's where people think the 20% to buy a house is needed. Technically, if you can save up to 10% of your home value, you can be able to cover most of your down payment and your closing costs if you're not able to get down payment assistance, if you don't find a home in a USDA loan, or you don't have a VA loan. But if you hire a real estate agent, we know things about different lenders and different builders that will offer something called lending or closing costs reimbursement or fees like that. They will give you the money for the closing costs. Okay, so that's why you hire a real estate agent to be able to explain that lingo for you on your behalf, so you don't have to come out of pocket this. Usually, because we're using the lender's money to purchase the house, they are able to offer a credit back to you in the form of a lender credit or a closing cost credit. And they will pay for all this for you just by using them in this process. Okay, because you're utilizing their money, and they usually going to make money on the interest rate at the end of the day. All right, so that is why you hire a real estate agent. If you need a real estate agent in the DFW area, I'm your guy that you should come check out. Yes, I am Joseph, realtor right here, and I can help you purchase a home if you're looking to purchase a home and help you walk through all these steps in a personalized manner, so that way you're getting the best product for the biggest investment of your life. Okay, so those are the down payment and the closing costs. Those are two things that you should be prepared for. So before you even start home shopping, try to save up to at least 10%. And I can show you how you can save up to at least 10% without changing anything you're currently doing right now, and just shifting your money in a different way. That is on my weekly webinar. You can find the link down below for that. Come sign up and I'll just show you how that can work. All right, moving on from that commercial. The next thing you want to really focus on is your debt to income. Yes, you want to see what is on your credit report. I talk about this in my credit video or my financial statement video. Go to this website right here and find out all of your debt that is on your credit. All right, annualcreditreport.com. On here, you're going to pull up all of your minimum payments for all the debts you have, and if you have collections. If you have collections that's over $1,000, you really need to work on getting those either paid for deletion or removed entirely. You really need to work on any collections that's over $1,000. Okay, collections over $1,000. So you want your collections to be under $1,000, but if they're over, you want to go ahead and get rid of those before you go try to get a mortgage at all. Okay. So what you need for your debt to income also is just your minimum payments. And I should have put this underneath another thing, because this is mostly job. This is not debt to income. But let me explain debt to income. So you want your debt to income to be enough that you can afford a mortgage, right? So you add up all of your minimum payments, add them all up, just your minimum payments, and you get a number. So minimum payments over your income. That is your debt to income. So if your minimum payments over your income is greater than 30%, because I'm just going to write that because just very different, um, different ways you can get a mortgage. If your minimum payments over your income is over 30%, you are not going to qualify for a mortgage at this point until you pay down your debt. What do I mean? Say your minimum payments is $1,000 and you make $3,000. If it's $1,000 in one, you're pretty much done with. Okay, you want to try to get your minimum payments in this range. Sometimes lenders can go up to 50%. So that means if your minimum payments is 1,500, if it's 50%, you can qualify. Just to be on the safe side, try to stay below this 30%. That way you have a high chance of qualifying. Okay, now that you got that, now you want to make sure you are working consistently, right? So you want to take your W-2 from the last 2 years. You want them to be in the same industry in the same kind of pay. All right, so if 1 year you got a bonus, but the next year you didn't get a bonus, then that bonus don't count. If you've been working there for only 6 months or less than 6 months, or if you had a gap of more than 6 months in between your work stuff, it's not going to count. Okay, it's very important you have a consistent work history before you go get a mortgage. Okay, the next thing we want to talk about is your credit score. So there's government loans that you can qualify for depending on your credit score. If you're in the 600 and to the 600 to 720, go with FHA because it doesn't matter what your credit score is. You get the same interest rate. They're just going to tack on PMI. And PMI stands for Private Mortgage Insurance. That is just basically a safe way to say, hey, we're going to give you this loan, but we have to attach an additional fee because you're consider higher risk at that point of defaulting. So they want to make sure they're getting that extra income on top of your mortgage already, your escrow process. So you have private mortgage insurance if you go with FHA, and it's very minimal. It's about $100 a month, but that adds up. That's $1,200 a year. So if you have a credit score above a 720, you can get a very good interest rate if you're above a 720 and you get no PMI. Usually you have to put down 5% for this, but you don't have to pay that PMI for all your loans, so you can save more money in your pocket. All right. So that is that. A non-qualified mortgage, you might have heard that as non-QMO, is for those that don't have good credit or those that don't have a social security. You just pay higher interest in this process. Now, one thing I want to say is any of these later on can be refinanced into a better loan. The best loan is the conventional loan because it offers you the best interest rate at the time of the market. So if you get your credit up, if you get into the house with an FHA, which is nothing wrong with that. I bought my house with an FHA, and then later on you refinance it back into a conventional loan, remove that PMI balance, and get you a lower interest rate. So that way you're paying more to your principal than just interest. This can help you out. Okay. Now, the last thing I want to talk to you about before I reveal the other things you want to do when you're buying your house is escrow. So, in escrow is basically a bank account that holds the money for you. Okay, so you send the money to escrow, and then escrow will distribute the money to where it needs to go. That's the cool thing about buying a house is you kind of have people working for you in this process. So the first thing you're going to pay the most of is interest, right? And if you're on a certain amortization process, you pay more interest at the beginning when you buy a house. And this is where a lot of people is like, don't buy a house because it's just not worth the investment. Usually people stay in a house anywhere from 5 to 7 years. During that 5 to 7 years, you're paying mostly interest. Yes, you're paying a little bit to principal, but most of that money is going to interest, depending on how you structure your loan. That's why you get your real estate agent to lay this out for you in a very personalized method. So if you need help with this, definitely hit me up at 469-907-9073 or email me. Link is down below. So interest. But the good thing about interest is it's tax deductible. So you can write off your interest at the end of the year and reduce the amount you pay in taxes. So that is a great process right there. The next thing is insurance. Always shop around for insurance. You will get flyers in the mail constantly. Hey, we got better insurance rates. Y'all come check us out. So find some good insurance that will help you cover the property. I'm not gonna mention none here because they could be changing at any time of this video made. But just shop around. Get at least 3 quotes before you actually buy your house. Okay. Principal. That is what you're actually paying to pay down the house value. So if you bought a house for 300,000, every time you make a paycheck, this 300,000 will go down. As it goes down, you start to get equity, right? So, equity is powerful because later on, this is a bank account, remember. Now your house is becoming a bank account with equity because you can later either get a HELOC, a home equity line of credit, which is like a credit card tied to your house, and you can pay off debt or you can buy other assets, but please do not buy the liabilities, okay? That is on a financial statement video, but you can actually use your equity to actually buy and pay for other things for you. Okay. So that's so cool about the principle. The last thing is property taxes. Property taxes are not going away. And the way the property taxes work is it's a percent of your home. So as your home value goes up, you will pay more in property taxes unless you are familiar with the homestead exemption. This is why you should get a real estate agent. When you get into your house, you go down to your county or wherever you're at and say, hey, I would like to apply for my homestead exemption. And what it does is it reduces the amount your house is valued for, so you pay less in property taxes. Got that? So get you a homestead as soon as you move into the house and reapply for it every year, depending on what county you're in. Okay. So, but that is forever. And property taxes go to fixing the roads, the schools, just your local area to build up your appreciation in your community. Now, most communities have HOAs if you go for like the new homes. So you want to pay attention to that. There's something called PID and MUD taxes, that is um, municipal utility district and planned uh, unit development. I think that's what it is. And those are additional taxes that is on top to help run more local stuff. So make sure you pay attention to that because that could increase your escrow over time if you're not familiar with that. Y'all, I appreciate y'all making it to this far. The last few things, this bonus clip that I want to give you is when you're shopping for a home, you definitely want to get an inspection. Do not take the word of the person that's selling your house, even if it's a brand new house. Get an inspection. That is the first thing that you need to get. The next thing you should really pay attention to is making sure to ask the seller or the person is if they can contribute any money to your purchase overall. That is where a good negotiator comes in, like a real estate agent, to help you get that taken care of. Y'all, that's pretty much where I have for y'all. I hope that this video was informative. I hope that you're ready to make moves and buy a house for your personal use if you haven't already. But definitely come out and check out what you can get qualified for by just getting a pre-approval first. I didn't write it on here, but just go get a pre-approval. All right, that's the last bonus I got for you actually, is to get a pre-approval. And to get a pre-approval, all you got to do is go to your local bank, or you can check out my lender down below. They will get you started and say, hey, how much of a home am I worth and I'm currently worth able to get? And a pre-approval or pre-qualification will just start that process. They will take your income and compare it to what you can afford and put you in a number that says, hey, this is what you qualify for. And then you just start the process. If it's not where you want to be at, or if it's not able to get you what you want, so that way you can start looking for what you can get qualified for, then wait 6 months, wait a year, but do it today. Your money is going to be the best amount of money today than it is later on. See where you're worth today and start building some equity so that way you can do something even more powerful later on down the line. Yo, I appreciate y'all watching it this far. Thank you so much. Share this video with somebody, rewatch this video if it's something didn't make sense, or just give me a call if you just want to have a conversation, connect, and I can help walk you through this process. I love y'all as always, and let's go make moves. Peace out.